If you are thinking about buying property in Spain, stop for a second, because the process in Spain is very different from countries like the UK, the US, Germany, or Netherlands. And if you don't understand how things work here, you could lose your deposit, get rejected by the bank after seeing document, or end up buying a property with legal problems. So in this video, I'm going to explain the complete process of buying property in Spain, step by step. From getting your mortgage approved, all the way to signing at the notary and receiving the keys. And I also explain the mistakes most foreigners make when buying in Spain. Let's start. Step 1. Know how much you can actually afford. Before looking at properties, you need to know your real budget. And this is where many people fail. Because in Spain, the bank does not only look at the property price. They look at your income, your debts, your savings, your nationality, your residency status, your job stability, your age, and even the type of property you want to buy. Normally, banks in Spain do not want your total monthly debt to exceed around 35% of your net monthly incomes. So, if you earn 3,000 euros net per month, the bank usually wants your total debt, including the new mortgage, to stay below approximately 1,000 euros monthly. Step 2. How much do Spanish banks finance? This is extremely important because many buyers think the bank finances the entire purchase. Usually, that is not the case. For Spanish residents, banks commonly finance up to 80% of the property value. For non-residents, usually around 60 to 70%. And there are additional purchase costs: property transfer tax, notary, registry, legal fees, mortgage cost. These extra costs are often around 10% of the purchase price, depending on the region of Spain. So if you buy a 300,000 euro property, you may need around 60,000 euros for the down payment, plus another 30,000 euros for taxes and expenses, meaning you may need close to 90,000 euros saved. Step 3. Get your documentation ready. Spanish banks love documentation. You will usually need passport or ID, NIE number, employment contract, payslip, tax returns, bank statements, proof of savings, credit information. And if you are self-employed, banks may also request company tax return, VAT declaration, businesses accounts. And if you are buying as a non-resident, expect even more documentation, especially regarding source of funds, international income, tax residency, currency, foreign assets. Step 4. Get pre-approved before signing anything. This may be the most important part of the entire video. In Spain, many buyers sign a reservation contract or even the deposit contract before having real mortgage approval. That can be extremely dangerous because if the bank rejects the mortgage later, you could lose your deposit, and deposits in Spain are often very large, sometimes 10% of the purchase price. That could mean losing 20,000, 30,000, or even 50,000 euros. So ideally, before signing the contract of the Arras, which is the private deposit contract in Spain, you should already know whether banks are likely to approve your mortgage. Step 5. Understand the Arras contract. The Contrato de Arras is one of the biggest differences compared to other countries. This contract usually means the buyer commits to buying, the seller commits to selling, and if the buyer backs out, the buyer normally loses the deposit. If the seller backs out, the seller usually has to return double the deposit. This is why signing Arras too early can be risky, especially if the mortgage is not approved yet, the property has legal issues, the valuation comes low. Step 6. The property valuation. In Spain, the bank will order an official valuation called a Tasación. And here is something many people don't know. The bank usually lends based on the loaner value between the purchase price or the valuation. So imagine you buy for 300,000 euros, but the valuation comes back at 110,000 70,000 euros. The bank may finance only based on the 270,000 euros, meaning you suddenly need much more cash. This is one of the biggest surprises buyers face in Spain. Step 7. Legal checks. Before buying, you should check not a simple debt on the property, ownership, urban planning issues, illegal constructions, tourist license restrictions, community debt, especially with rural properties, villas, older homes. Legal issues are more common than many foreign buyers expect. Step 8. Final mortgage approval. Once your financial profile is approved, the valuation is approved, the property passes legal checks. The bank can issue the official mortgage offer. In Spain, this is called FEIN, Ficha Europea de Información Normalizada. This is the binding mortgage offer. It contains interest rate, monthly payment, mortgage conditions, linked product, fees, and once you receive the FEIN, you normally have a legal reflection period before signing. Step 9. The notary appointment. In Spain, property purchases are signed at the notary. This is where buyer, seller, bank, or sometimes lawyer or agents all meet together. The notary reads the documents, verify identities, explain the mortgage, confirm legality. Then the buyer transfers the funds, and finally, you receive the keys. Step 10. After the purchase. Even after signing, there are still things to do. Register the property, change utility contract, pay taxes, update ownership records, arrange insurance, set up direct debits. And if you are a non-resident, you may also have annual tax obligation in Spain, even if you do not rent the property. Many foreigners do not know this. Let's quickly cover the biggest mistakes. 1. Signing Arras too early. Very common, very dangerous. Underestimating taxes and costs. Many buyers only calculate the property price, not checking legal issues, especially with villas and rustic property. Assuming all banks work the same. Every Spanish bank has different policies. Thinking mortgage approval is guaranteed. Even high-income buyers can get rejected. Buying property in Spain can be an amazing investment and an incredible lifestyle decision, but the process is very different from many other countries. So the key is plan properly, understand the risk, and get professional advice before committing financially, because one bad decision early in the process can cost you tens of thousands of euros.